Hello, I'm Chris Sarley, Investment Research Analyst at Fund Calibre, and today I'm delighted to be joined by Bruce Stout, Manager of the elite-rated Murray International Investment Trust. Bruce, thanks for joining us today.
It's a pleasure.
I want to start with emerging markets. You've made no secret of your preference for this region, and that's been reflected by an increasing sort of allocation versus the developed world in recent years. Could you explain why this is the case and whether you think that trend will accelerate because of the recent crisis?
Yes, of course. Well, there's two parts to this question. As you say, the first question is why emerging markets? The second part is, has anything changed because of the current circumstances? I think in terms of the why, it's pretty straightforward that when we're looking for new businesses to put into the portfolio that will deliver the investment mandate of Murray International, which is growth and income, then the companies that tend to come up tend to be domiciled in Asia and emerging markets because of the growth and the characteristics that are there. If we were to consider maybe 3 or 4 of the most recent purchases, I'll not go into any detail, but Global Wafers that we bought is in Taiwan. It offers growth and it offers above average dividend yield. And Telecom Indonesia, again in Indonesia, offering growth and good dividend yield. Telenor in Norway is domiciled in Norway, but 2/3 of the business is focused in the growth markets of Asia, in places like Pakistan, Bangladesh, Myanmar, Thailand, and Castle India as well, another recent purchase where we find good growth and above average yield supported by a very strong balance sheet. So it's really a function of the type of companies that we're identifying. In terms of will anything change? Well, it's very difficult to say it at this point, but the positive aspects of growth with the young populations, the favourable demographics, the rising real incomes, the pent-up demand and purchasing power are all still there. And I guess looking forward, the cost of what's going on at the moment for the developed world will be significant, and it's coming from a position of over-indebtedness in the first place, so it just makes it even harder, I think, to grow going forward from here.
You touched on it briefly there. I understand you started selling or shifting some of your bond exposure into equities on the back of the sell-off. Could you talk a bit more about some of those companies you've been buying and why?
Yeah, I mean, it's slightly similar to the situation in 2008, where we had a lot of bonds going into the financial crisis for different reasons. Again, we had bonds coming into this situation. We weren't geared into equities. So we took the opportunity to sell down some Brazilian short-dated sovereigns and some Indonesian short-dated sovereigns because they held up really well. We bought into AbbVie, which is a US-based drug company that recently bought Allergan. We bought into a company called Broadcom, which is software and semiconductors. A lot of its business is in Asia. We added to TC Energy, the Canadian pipeline business, and we added to a position in Grupo Azul, the Mexican airport operator. And all those positions were at very favourable prices, picking up yield from switching from bonds to equities, and of course, hopefully picking up dividend growth in the future as well.
Obviously, dividends are a big buzzword at the moment. With a dividend yield of around 5.7%, income's obviously a big part of the trust's attraction. How are you managing the significant cuts that are expected in markets? And is your dividend reserve fund in a good position should you need it in this scenario?
Yeah, well, some of the dividend cuts have been absolutely brutal, as we've seen over the last couple of months. And that's not surprising because for many businesses, businesses just completely stopped and it's been all about preserving liquidity. I think one of the features of Murray International is we're not dependent on one market or one region or one sector or one industry. It's a very diversified global trust. We have the 16% in bonds, big position in bonds, which is good. We've been defensive in terms of our telcos. We own about 17% in telcos, where the free cash flow dynamics of companies like Telecom Indonesia, Telenor that I mentioned before there, Verizon in America, Singtel in Singapore, very, very strong. And of course, those businesses are not being interrupted as much as sort of tourism and hospitality and things, because people have been using a lot more data and a lot more telcos. So the cash flow dynamics there are positive. Our pharmaceutical exposures looks pretty strong, as does our consumer staple. And we do have about 12% in technology, again, like Taiwan Semi, very strong balance sheets and lots of cash. So we won't be immune from some of the dividend cuts. And indeed, we've had a couple ourselves in terms of Auckland Airport in New Zealand. And obviously Shell reduced its dividend. We can talk about that later. But the trust has been building up reserves over the last 10 years. We put 30 million into reserves. So we've got £75.5 million, which equates to about 58.5 pence a share. And the dividend last year was 53.5. So we've been putting a lot of it away for a rainy day, and this is a rainy day.
You mentioned Shell. There's no time like the present. The trust holds or continues to hold positions in the major oil companies like Shell and Total, despite the volatility we've seen in oil prices. I guess, firstly, tell us why this is, and maybe tell us a bit about why you're looking for dividend-paying businesses which give you the confidence to continue holding them.
Yeah, well, the energy business is always really, really difficult. We only have the two positions, one in Shell and one in Total. I think in my investment career, I've seen the oil price oscillate between about $10 and $100 5 times, but I've never seen it go negative, and that was quite an unusual situation last month. But the double whammy of all economic activity stopping at the same time as a collapse in the demand for oil put enormous pressure, obviously, on the balance sheets there. I think what we'd say is that both those companies, Total and Shell, have very strong balance sheets. Shell did cut its dividend the first time, I think, in about 80 years in order to free up some liquidity, and that's maybe a wise move in their situation. Total has decided to maintain its dividend through this period of time. But I think the key thing here for the future for both those companies is they're very strong in what they do, and they're looking in the future to provide different types of energy, reducing their carbon intensity over the next 10, 15 years, moving into more sort of low carbon energy, and liquid natural gas, LPG gas and things. So they've got the balance sheets and they've got the distribution to do that. And I think that's where the focus of their capex will be in the next 5 to 10 years.
The next question has a couple of layers to it. Firstly, the trust currently has a combined 75 or so positions in bonds and equities. Is this a sort of environment where attractive valuations could see you increase the number of holdings? And also, have you potentially been using the gearing to take advantage of some of these opportunities the market's presenting?
Yes, well, in terms of the number of holdings, we've been relatively consistent with about 50 bonds, 50 equities, 25 bonds over the last few years. There's no great desire necessary to increase the number of holdings. It's a question of, do we have high comfort levels in the type of businesses that we're looking at in this type of environment going forward that will be able to grow the dividend and will be able to grow their earnings? Because this is an event that we've never seen anything like this before. It's not like when the tech bubble burst or when the housing market or the banks went bust, because this is a pandemic in a condition and we don't know how long it's going to last. And so when we're moving money from bonds to equities, we have to be very, very comfortable that the dividends will be there and we will get the income. Now, there's no desire to increase the nominal amount of gearing in the trust, which at the moment is 200 million. But we obviously have the firepower there of reducing our exposure to bonds and moving into equities, which we have already started to do or did in March to the tune of about 5%. So there's plenty more to go there if we are confident in the valuations and confident that we're going to come out of it with earnings and dividends intact.
And just lastly, I wanted to talk all things UK. Your UK exposure is at an historic low. Is this because you believe the UK's long-term history of sort of being the go-to place for dividends is coming to an end?
Well, it's a bit difficult to comment in terms of what the outlook for the UK is in terms of it used to have a sole place, if you like, because 20 years ago there was no dividend yield in Asia, and there was no dividend yield in Japan, and there was very little dividend yield in the US. So the only really place you could get it was the UK and patchy in Europe. But rather than consider the UK coming to an end, we would look at the beginning, if you like, of the dividend culture that we see in Asia and emerging markets, because what we've seen in the last 20 years is absolutely remarkable, going from companies that had no focus on dividends for shareholders to companies now that can comfortably pay 4% above dividend yields, but without sacrificing the growth. And therefore you get payout ratios that are not stretched the way they are in some of the developed countries. There's plenty of cash to come to shareholders and to reinvest in capex. And that's just a feature of more and more companies that we see in Asia. And that's why they are so attractive. And remember, in emerging markets in Asia today, these are orthodox economies following orthodox economic policies. So there's lots of flexibility on the monetary and fiscal side. That is not the case elsewhere in the world. So it's more straightforward to analyze a company against that backdrop than it is in the developed world. So we would look at it more as the beginning of the real income focus and dividends that we see going in the next 5 to 10 years coming out of those strong companies in Asia and emerging markets.
Bruce, thank you for spending the time with us today.
It's a pleasure. Thank you.
For more information on the Murray International Trust, please visit fundcalibre.com.